Welcome to perso- for this class, which is focused on personal finance. Today is a personal finance class. We are using a McGraw-Hill book. Uh, this is in terms of copyright 2022 is by Kapoor, uh, Diabrai, Hughes, and Hart. Okay, this is the seventh edition. The name of the book is Focus on Personal Finance. So there's a couple of, this is quite a long chapters, so just bear with me. All right, let's start this chapters. And there's about five objectives. The first one to analyze the advantage of using and disadvantage using consumer credit. Number two, assess the type and sources of consumer credit. Number three, determine whether you can afford a loan or how to apply credit. Number four is to determine the cost of credit by calculating interest using various interest formula. Number five, the flow of plan to protect your credit and manage your debt. Okay, objective number one. What is credit? Credit is an arrangement to receive cash and goods or services now and pay for them in the future. Consumer credit refers to the use of credit for personal needs except at a home or mortgages. It is based on a trust in a people's ability and willingness to pay bills when due. And it dates back to colonial times. The installment credit in which the debt is repaid in equal installment over a specific period of time exploded in the US with the creation of automobile in the early 1900s. So people buy automobile with using credit. Uses misuse of credit. Before deciding on how and when to make a major purchase, consider many of the following. Do I have cash that I need to pay for the down payment? For example, you want to buy a car, you need to have a down payment. Okay. Do I want to use my saving to for this purchase? If you have saving, that's good. If you don't have, then you have to save. Does the purchase fit my budget? Make sure you are able to pay the monthly payment. Could I use a credit? I need to for this purchase or in some better ways. Okay, can I postpone the purchase? If you need a car to travel to work, then you have to no choice. You have to use a car. But sometimes you can postpone it by using a public transit. And then what are the operating costs for pursuing a purchase? For example, I want to buy a new car. Example. This is a good example that I have. I've been aiming for to buy a new SUV, but whether this I've been postponing for the last 3 years to be. That's why I was wondering whether there's the opportunity cost. Because if you buy a car or lease a car, you have to do payment every month. That's going to create a burden on your cash flow, right? And then what are the costs and psychological costs for using the credit? Okay, that's the key part that you need to answer. What are the advantages of credit? When you are in Canada, you have to develop a credit score, credit records, okay? Consumer credit enables people to enjoy goods and services such as car, home, and education. It's like I'm able to get a mortgage because I have a good credit score. That's the reason why. It provides also emergency in case you need money. Credit card permits the purchase of goods even when the funds are low and provides shopping convenience. Advance notice of sales and the right to order by phone. Self identifications when cashing checks. Provides a record of expense and up to 50-day float. That's the key part. Credit allows you to shop and travel without carrying a large amount of cash. That's another advantage. Credit indicates stability, ability to, you're mature, you're able to be trusted in terms of credit. What are the disadvantages? Temptation is to overspend. This is what is the most common problem for average people like you and me. We tend to overspend. Impulse buying can create a serious long-term financial problems and damage family relationship and delay progress toward financial goals. That's the key part of disadvantage. Failure to repay may result in loss of income, valuable property, as well as your good reputation. Can lead to court action and bankruptcy. Ties up your future income as well. It costs money and paying for the purchase over a period of time is more costly than paying with cash. That's advantage number one. This disadvantage, okay? Now look at the types of credit. Types of credit. Closed-end credit are one-time loans that borrow pay back in a specific period of time and payment in equal months. Installment sales credit is a loan that allows you to use merchandise, usually high-price item. High-price items, let's say you want to buy a car, that's a good example, installment sales credit, or there's another one we call it installment cash credit. It's the direct loan of money for personal purposes. This is from personal loan investment, personal loan overdraft. And also you have a single lump sum, which is a loan that must be repaid in a total of a specific day usually within 30 to 60 days. Okay, and then open-end credit is a line of credit with which loans are made on a continuous basis and the borrower is billed periodically for at least a partial payment. You may have to pay interest and other financial charges as well. If this is an example, closed-end and open-end. In Exhibit 5.1, you have a closed-end credit, which is such as mortgage loan. You have, let's say, my mortgage here is 25 years. Automobile loans used to be about 5 years to 4 years, up to 2. The minimum is usually 2 years. Installment loans, such as contract, cash credit, single lump sum credit. This is the closed-end credit. The open credit usually credit card used by department stores such as Visa and MasterCard, and travel and entertainment such as American Express, Diamond Plus, and as well as overdraft protection. I always use overdraft protection in case for my cash flow, right? It's part as open credit. Help me manage my cash flow. This is a typical consumer credit. Has billions of dollars, has increased substantially. Okay, this is given by Federal Reserve. A major force in American. Okay, well, American is very well known for high spending and high credit card debt. Okay. Open-end credit cards here, average account holders has more than 9 credit cards, including bail, retail, and gasoline cards. Convenience users pay off their balances in full month each month. Borrower do not pay off their balance every month, then you're going to be charged interest rate. Most credit card companies offer a grace period, a period in which no finance charges will be added to your account. Finance charge means the total value of amount you pay to use the credit. Beware of the teaser rate, because this teaser rate means it takes you to take the credit at the discount, let's say about 9% or 10%, but in actuality, maybe 20% or at least 22%. Some credit charge annual fees, okay, that's the key part you need all to know. Credit debit card is actually subtract money from your saving and checking account to pay goods and services. Mostly you can use it at ATMs. This is debit card you pay. And stock value credit card, gift card, and prepaid card are prepared with cards, providing you with immediate money. Bankruptcy court gift card is the same way I handle unsecured debt. Okay, that's the key part, unsecured debt. So stock value card, like if you go to Best Buy, they have a value card, and you go to Home Depot, you get value card. The same thing with Tim Hortons. You want to give somebody a Tim Hortons gift, $50. This can be do. Smart card, a plastic card equipped with computer chips, then can store 500 times and much data. There's a normal credit card. There's another way. What are credit card? There's the 3-year travel and entertainment cards are balance due in each month, such as Diners Club and American Express. So if you charge 1,000, you have to pay 1,000 right away. Smartphones are now made to make purchases. Okay. Mostly like mobile commerce, the ability to purchase using a mobile device that has been significantly increased in interest from consumer retailers and finance companies. Okay. What are the commercial banks? This is a source of consumer credit. The first one is consumer commercial bank, from single loan to credit loans to credit card loans to primary and secondary mortgage. This is commercial bank. Usually the lending policy is that they usually go for customers with established credit history, often require collateral as security, prefer to deal with large loans such as vehicle, home improvement, or home modernizations. Okay, determine repayment schedule according to the purpose of the loan, vary credit rates according to the type of credit, time period, as well as customer credit and history, and may require several days of process of new credit applications. The second one is a consumer finance company, usually like personal installment loan, primary mortgage, and second mortgage. Often lend to consumer without establishing a credit history. Often make unsecured loans. Okay, and then in terms of par rate, they according to the size of the loan balance, offer variety of repayment schedule, make a higher percentage of a small loan other than other lenders. Maximum loan limited by law. Process application quickly, frequently on the same day an application is made. Credit union based on a personal installment loan, share credit plans, credit card loans, do a primary mortgage as well as secondary mortgage. This is for credit union. They act almost like a bank, but it's a smaller version of it. Okay? But the key part, they only lend to members, make unsecured loans, also make required collateral for consignment for loans for over a specific amount of time. It may require payroll deductions to pay off loans, may submit last loan application to a committee of members for approval, and offer a variety of repayment schedule. Life insurance company, life insurance company is single payment or partial payment loan. Land a cash due based on life insurance policy, no debt penalty or repayment. Deducted amount owed from the value of policy benefit is the debt to the maturity occurred before the repayment. For the saving banks, is another one. This is mostly in the US, okay? SNL, such as personal installment loan, a home and equipment loan, saving account loan, primary mortgage, as well as secondary mortgage. We loan mostly to all credit-worthy individual. And the loan rate will vary, it depends on the size of the loan. The source of consumer of credit will be like loans involve borrowing loan with an agreement to repay it as well as interest within a certain amount of time. And inexpensive loan are loans with low interest, and the sources of this loan are often family members. Medium price loan, which has loan with a moderate interest, and the source of this loan are often with commercial banks, saving and loan association, as well as credit unions, and provide personalized service and are usually patient with the borrowers who can provide good reasons for late and missed payment. Source of consumer credit, expensive loan. Loans are loans with high interest rate and often ranging from 12 to 25%. Bank also lend money to the credit card holders through cash advances. Loans are billed to the customer credit card account. It's expensive. The rate is 12 to 25%. And then you also have the home equity loan. Loan are based on your home equity, the difference between the current market value of your home and the amount you still owe on the mortgage. It is interest tax deductible, should only be used for major items such as education, home improvement, or medical bill. You must use them with care. Example home equity loan. Here's an example, guys. Depending on your income, equity income, you can apply for a line of credit within 10,000 to 250,000 or more. Some lenders allow you to provide up to 75% value of your home, less the amount of your first mortgage. At some bank, you may qualify to borrow up to 85%. This higher lending rates may make the difference in your ability to get the money you need to home improvements, education, and other expenses. Use the following chart to calculate your home loan value, which is approximate the amount of your home equity line of credit. This is an example. Approximate market value, let me just accident push it up. Market value is 200,000. Your value how much? Multiplied by 0.055. You got the approximate loan value 150 divided this. Subtract balance due on mortgage is 100,000. Approximately available will be 50,000. Okay. Equal credit opportunity. This is objective number 3. ECOA. This is in the state. Equal Credit Opportunity Act state that race and color, age, sex, marital status, and other factors may not be used to discriminate against you in any part of credit dealing. Before you can take out a loan, ask yourself, can you meet all the essential expenses and still afford the monthly loan payments? What do you do? What do you plan to give up to make monthly loan payment? Now the general rules of payment to ratio to income is calculated dividing your monthly debt payment, excluding your house payment, and by your net monthly income. Okay, expert recommends spending no more than 20% of your net income on consumer credit payments. Debt to equity ratio is calculated by dividing your total value to your net worth. Do not include the value of your home and the amount of its mortgage. Debt to equity ratio is 1 to the upper limit of debt obligations. There are about 5 C's, okay, of credit. Most lenders build policy to determine who will receive the credit based on the 5C of credit. The first one is character, refers to the borrower attitude towards his or her credit obligations. Number 2 is capacity, is the borrower's ability to pay additional debt. Number 3 is capital, which is the borrower assets of net worth. Number 4, which is the collateral, is the valuable asset that is pledged to ensure loan and payment. Number 5 is conditions, affect the borrower's ability to repay the loan. This is very important for your credit report. Credit report, credit file is a record of your complete credit history. In Canada, will be like TransUnion or Credit Facts, okay? Credit bureau or agency are collect information on how promptly people and business pay their bills, such as TransUnion and Equifax. That's the most common one. Experian, the three one. Experian, TransUnion, and Equifax are the three major credit bureaus. Credit bureau obtain information on banks, finance companies, stores, and credit card companies and other lenders. Typical credit bureau contains the following information such as name, address, social security number, birth date, employer, position, and income, previous address and employer, spouse name, social security number, employer, and income, whether you rent or your home. Checks return for the insufficient funds. For Fair Credit Reporting, Fair Credit Reporting Act is 97. The U.S. Congress enabled the Fair Credit Reporting Act, which regulates the use of credit reports. Require out-of-date information to be deleted. Gives consumer access to their file as well as ability to collect information. It's the place where you can obtain your credit report. What is your credit report? It is properly identify a person to have your credit report for proof legitimate purpose. This is mostly if you work in a bank, like insurance company, mostly they will ask for they will do a credit check or credit report for you because they want to make sure you are in good character. Remember the 5 C's there. Okay. Maybe supply and respond to a court order of your own return request. May be provided to use in connection with credit transactions, underwriting of insurance, and some legitimate business needs. Most information on credit file may be reported for only 7 years. 7 years, that's the key. I think in Canada it's about 6 years. Personal bankruptcy may be reported up to 10 years. Credit reporting agency cannot disclose in your credit more than 7 to 10 years old unless you are being reviewed for credit application 75,000 or more, unless you apply to purchase time insurance 150,000 or more. Okay. Credit bureaus are required to follow reasonable procedures to ensure the information in their file is correct. You may request a copy of your credit information within 60 days of being denied credit. You have the right to sue a credit bureau or creditor that has caused you harm by not following the rules established by the Fair Credit Reporting Act. What is credit score? Credit score is a number that reflects the information in your credit report. Scores summarize your credit history, how creditors predict how likely is you will repay a loan and make timely payment. FICO is the credit score ranges from 300 to 850. The higher the score, the less risk you pose to the creditors. Available for free. Okay? Vantage score is another scoring technique, the first to be developed collaboratively by the three credit scoring system companies. Common score ranging from 501 to 990. This is your FICO score. Okay? Shows you an example of your score, FICO score. A length of credit history, and then payment history, number 35%, account amount owed, type of credit used, and new credit. This is the typical. What they're going to focus on. Equal Credit Opportunity Act specify the following. As may be requested by a creditor on the application, but you cannot be turned down or experience a decrease in credit because of the age. Age, you may also be denied credit because you receive Social Security or public assistance, but this income may be considered determining credit worthiness. Okay? Redlining is a discrimination based on the race or nationality of people in the neighborhood in which you live or want to buy a home based ban on housing loans. If the lender uses a risk-based pricing, they must disclose important details to customers. Okay? What is your application denied? You are denied credit. The ECOI gives you the right to know the reason. If denied based on the credit card report, the credit bureau, you are entitled to a free credit report within 60 days. You are entitled to ask Bureau of Credit to investigate any incorrect information to correct your records. What happens if you have credit denied? Check your credit and file the credit bureau. If you believe the reasons are valid, then you can do all these three things. Ask the creditor if you can provide additional information, apply another credit to another creditor, and take steps to improve your credit worthiness. Okay? If you're not sure the reason why and for denial, ask the creditor to clarify the reason. If your reasons are invalid, the credit has discriminated against you, then you can notify the fair enforcement agency that you are given, and then the fair enforcement agent will discriminate. For example, let's say if you are a minority, or let's say you are a minority color of skin, or you have a different sex, yeah, let's say you are a member of LGBTQT, and then you believe that you are being discriminated again because of your LGBTQT, then you can file a complaint to federal agency. Okay, or you can also hire a private attorney to file a suit against the creditor. So it's going to be a long process there. Then, if you're caught fine discrimination, then the creditor must pay the actual damages. Okay. So how can you do to improve your credit score? Get copies of your credit report, verify the information, pay your bill on time. That's number two. Understanding how your credit score is determined. Number four, learn the legal step to improve your credit report and beware of the credit repair scams. That's the key part. Beware of your credit repair scam. Okay. Number four, finance charges. Is the total amount you pay to use the credit, include the interest cost and sometimes other costs such as service charge or credit-related insurance premium or appraisal fees. As annual percentage rate is the percent of cost or relative cost of credit on a yearly basis. Key to compare cost regardless to the amount of credit or the how much time you have to pay for it. Okay, look at the arithmetic annual APR percentage. There are two ways in calculating them. APR is using the APR formula and using APR table. The APR table are more precise than the formula. The given formula is this one: R equal to 2 times N times I divided by P close bracket N plus 1 close bracket. R is approximate APR. N is the number of payment period in 1 year. Okay, I is the total dollar cost credit, which is I, and then P is the principal or the net amount of loan, and is the total number of payment which goes to pay off the loan. Okay, let us compare. $100 loan is paid off in one lump sum at the end of the 1 year. When the same loan is paid off by 12 times, equal to the monthly payment, the stated annual interest rate is 10% for both loans. Using the formula, the APR for lump sum loan is R. So you're going to plug in the number, you get 10%. Using the form APR monthly payment, you plug in the number, you got 18.46%. So you just use that formula. Then you plug in the number, you get the numbers. You calculate, you get the numbers. Tackling the trade-off. Term versus interest cost. Many people choose longer term financing because they want smaller money payment, but the long-term payment for loan at the given interest rate and the greater amount of you must pay interest charges. Lender risk versus interest rate, which is to reduce the lender risk, you can accept a variable interest rate, provide a collateral secured loan, provide upfront cash, and take a short-term loan. Okay, to calculate the cost of credit, the simple interest is the interest computed on the principal loan and without compounding, which is interest equal to principal times interest rate times. When simple rate is paid back, it is in more than one payment. The method of computing interest is known as the declining balance method. You pay interest rate only the amount of principal that you have not yet repaid. Okay, with the add of interest method, interest is calculated on the full amount of the original principal, no matter how frequently you make the payment. So using the simple interest formula, okay, this is the a case study. Suppose you persuade a relative lend you 1,000 to purchase a laptop computer. Your relative agreed to charge only 5% interest and you agree to repay the loan at the end of 1 year using a simple interest formula. The interest will be 5%, okay? For 1,000 for 1 year for $50, which is, since you have the use of 1,000 entire years, you're going to calculate I equal to 1,000 times 0.05 times 1, which is $50. Using the APR formula will be, just plug in this formula, you plug in the numbers, you get the 5%. Remember, the stated 5% is the annual percentage rate. In calculating the cost of credit, there's a cost of open-end credit. The truth is, in Lending Act requires that open-end creditors inform consumer as and how to finance the charges, and the APR will affect their cost. Cost of credit and expected inflation. Lenders incorporate the expected rate of inflation when deciding how much interest to charge and avoid the minimum money payment trap. Remember, the longer you pay off the bill, the more interest that you have to pay. That's the key part. Okay, try not to pay at the minimum side. You have credit card charges. Always try to pay all as much as soon as possible. Okay. Number 5, objective number 5, Credit Billing Act, which is FCBA, set a procedure of promptly correcting billing mistake. Refusing, this is in the US Act, okay? This is a US Act. Canada has the different acts. Refusing to make credit card payment and defective goods and promptly crediting payments. Follow this step if you think your bill is wrong, okay? Notify the credit of an error. Pay the portion of bill that is not in dispute. Creditor must respond within 30 days and credit card has to be repaired, but no longer than 90 days. And to correct your account and tell you why you think the bill is correct, okay? Billing errors and dispute. There's a billing error and dispute. What you need to do? Creditor may not threaten your credit rating to do anything to damage your credit reputation while you are negotiating a billing dispute. Creditor may not take any action to collect the amount in question until your complaint has been answered. If there's a sincere effort to resolve problem when an item purchase has been made, but the store is not cooperative, then you can ask for your credit card company to stop the payment. Identity crisis. What to do if your identity is stolen? This is the most common one. Now, guys, make sure when you have credit card, you have to save it in the safe lock, digital safe lock. What happens if your identity is stolen? Number 1, contact the credit bureaus. Okay. Tell the bureau of the flag, your file, a fraud alert, including a statement that creditors call you to permission before they open a new account in your name. Number 2, contact creditors. Contact the creditors for any account that have been tampered with or opened fraudulently. Follow up in writing. Number 3, file a police report. Keep a copy to the creditors. Protecting your credit from the theft or losses or theft or loss. This is the most common one. Okay, guys, credit. Follow this tip to protect your credit from theft or loss. Shred any papers that contain personal information. Check machine carefully to avoid skimming. Close your account immediately if you suspect identity theft has access to the account. I have done in the past. Suddenly my credit card being used somewhere in Europe, in Netherlands. So I just reported right away. Okay. I have always have a credit notification of any charges coming from for every my credit card. Be sure your credit card is returned after purchase. Keep a record of credit card numbers. Notify a credit card company immediately if your card is lost or stolen. Protecting your credit information on internet. Protect your credit information on internet. Follow these tips. Use a secure browser. Keep records of online transactions. Review monthly bank and credit card statement. Read the privacy and security policy of the website you visit. Keep personal information private. Never give your password to anyone online. And do not download files sent to you by any strangers. This is the key part. That has happened many times. And one of my friends, he downloaded the link and he lost the money in the banks. Okay, and if you have a Android system, open system, then if you download the files, they can trace your credit card detail. Consigning a loan. Consigning loan means you agree to be responsible for loan payment if the other party fails to make them. Remember, the lender must be not required to co-sign if the borrower has made a good risk. Ask yourself if you can afford the loan if the borrower defaults. If borrower doesn't pay, consignor is liable for the full amount of the debt plus any late fees or collection costs. Creditors can collect the debt from you without first trying to collect from the borrower. Complaining about consumer credit. If you believe the lender is not following the consumer credit protection law, try first to solve the problem directly with the lenders. If that fails, you can file a complaint procedures. These are the list. These are the numbers. Okay. For consumer reporting agencies, creditors are not listed. They're called FTC, Federal Trade Commissions. This is the number. For National Bank, this is Control Alliance. This is the numbers. Remember, this is in Washington DC. This is in US. Canada has a different numbers. Okay. Again, for the Reserve System, this is the numbers, and this is US. For the Federal Union, this is the numbers. For State Chartered Bank, this is the numbers. Again, this is in the US. Canada have a different one. Okay. These are the consumer protection law. Protection law here. These are the law are available from the state. Okay. In the US, Canada with different names. Okay. But overall, it will be the similar. If you are unable to find a relation to credit card situations, the CFPB, which is Consumer Financial Protection Bureau, has created a one-stop shop complaint website for credit card issues. Website allows you to submit complaint and monitor progress of complaint through the investigations. And then debt, managing your debt. This is a key part. Warning sign of the debt problem. Paying only the minimum balance for each month. Trouble paying the minimum balance. Total balance on credit cards increase every month. Missing loan payment or paying late. This is a typical sign. Using saving to pay your necessity. Getting second or third payment due notice. Borrowing money to pay all debts. Exceeding credit limits on your credit cards. And being denied credit due to the bad credit report. This is typical sign of debt problem. So you have to manage your debt, guys, properly. Debt collection practice. This is based on the FDCPA, Fair Debt Collection Practice Act, which prohibits certain practice of debt collectors, business that collect debt, and for creditors. Does not erase legitimate debt for consumer owe. Control the ways in which debt collection agencies may do business. Okay. Financial counseling services. Okay, if you have a debt problem, usually there's a consumer credit counseling service, which is a non-profit organization that provides debt counseling service to families and individuals. Counseling is usually free, but if CCS supervised debt repayment plan, it sometimes charges a small fee to cover admin costs. Emphasize and preventing problems such as does is following the problem. Help people manage the money better and set up a realistic budget. Do not do impulse buying. This is the most common problem with the average joint Jane impulse buying. Educate people about budget planning, pitfall, and unwise credit buying. And encourage credit institutions to withhold credit from people who cannot afford it. Other counseling services such as university, credit union, military-based, state, and federal authorities sometimes provide non-profit credit counseling service. Check with your financial institution and consumer protection that have a list or reputable counseling service. Okay, this is basically a psychologist service. Bankruptcy, declaring bankruptcy. You don't want to do it in bankrupt because when you declare bankrupt, nobody want to lend you any more money. That's you're gonna be so easy, so difficult to find credit. Bankruptcy is basically, but you need to know what is bankruptcy. Basically, it's a legal process in which some of all the assets of a debtor are distributed among the creditors because debtor is unable to pay his or her debt. Bankruptcy should be the last resort because it will severely damage your credit rating. Remember, guys, it's your last resort here. Medical bills are the leading cause of bankruptcy. This is the most common one, guys. Medical bills. If you don't have insurance there in the U.S., you're in trouble. A lot of medical bills. U.S. Bankruptcy Act, Chapter 7 is state bankruptcy. Chapter 13 is for wage earner plan bankruptcies. Okay. This is consumer bankruptcy filing. It shows you an idea how long it takes. And 2019 is 752,000 there in thousand. Okay. Chapter 7 bankruptcy, you must submit petitions to the court that lists asset liable to pay filing fee of 350. Many but not all debt are forgiven. Assets sold to pay creditors. Okay, release from debt does not affect alimony, child support, certain tax, fine, and these other certain debt arising from educational loan that you failed to discuss properly to the bankruptcy court. Debt arising from fraud, arising while intoxicated, or certain criminal acts may be as well excluded. Bankruptcy Protection and Prevention Protection Act 2005. Under this law, Americans have the ability to pay debt. Will be required to pay back at the least portion of their debt. This is based on the U.S. side. Okay, so debtors seeking erase all debt to have wait 8 to 8 years to file their bankruptcy again. Climb down bankruptcy bills so that you cannot file bankruptcy all the time. Okay, if you have to wait 8 years, that's basically what it is in the U.S. Bankruptcy chapter continue here. Debtor will the regular income propose a plan for using future earning asset to net his or that over time. Debtor normally keep almost of his or property. Information provided by court is the same what is required under Chapter 7. Pay may last up to 5 years. Debtor make payment to court-appointed trustee. So, in fact, bankruptcy, obtaining credit may be more difficult after filing. A list of banks can find some find the process easier because they have to remove the burden of prior debts. Obtaining credit may be easier for Chapter 13 files who have repaid some debt versus Chapter 7 files who made the offer to repay. So, in summary, basically, Chapter 1, the summary in analyzing the advantages and disadvantages of using consumer credit. These are the list of advantages from the ability to purchase goods when needed and pay them to gradually to establish our credit rating. This advantage will be from credit cost money to ties up the future income. Chapter summary number 2 for objective number 2. Closed-end and open-end credit are two types of consumer credit. Okay. Objective number 3, determine whether you can afford a loan and how to apply for credit. There's general rules measuring credit capacity such as debt payment to income ratio and debt to equity ratio. Chapter 4 as objective 4 summary, which is determining the cost of credit by calculating interest using various interest formula, comparing the finance charge and a percentage rate of APR that you can shop the credit. Okay. And then number 5, develop a plan to protect your credit and manage your debt. Such as if there is a billing cure, you need to notify the creditor writing in 60 days. If you have a complaint about credit, first you need to deal with the creditors. If fail, then you can turn to the appropriate consumer credit law. And then number 5.5 again, develop a plan to protect your credit and manage your debt. You cannot meet your obligations, contact your creditors. That's the key part, contact your creditors, okay? Alright, so basically this is the end of chapter 5. Okay, I'm going to close this. I'm going to upload this in YouTube as well as do a puzzle. Okay.